Thank you all for joining us today for this part of our series, the International Private Client Webinar Series on Giving for Good around the globe. I'm joined today by colleagues and friends, Mark Powell and Lindsey Kernan from Southern California. I'm coming to you from Florida, and we welcome you all, and I believe we even have some international attendees with us as well. So we greatly appreciate all of you taking some time out to join us for our discussion today. Before we give a brief overview and then begin our presentation, I just wanted to again let you all know that the Q&A tool is there for you to answer questions. We'll try to answer those at the end of the presentation. If for some reason we do not get to your question, have time to address it, we will follow up. So, and you're welcome to contact us after the presentation as well. Also, a few brief words about our team. Our nonprofit and tax-exempt organizations team straddles our private wealth services practice group and our tax team, tax group within our firm. We can cover just about any legal issue that you can imagine in the exempt organization world, but a lot of us also spend time on the private client side, helping our clients create foundations and even public charities, and also deal with international issues, whether it's giving going outbound outside the United States or inbound to the United States. So we'll try to share both perspectives with you today. And now I'm going to turn it over to Mark Powell, who will introduce our topics, give an overview, and then dive into some of the income tax issues with charitable contributions. Mark?
Thanks, Jason. So welcome everybody. Just a brief overview of what we're going to cover today. I'm going to start out by laying some groundwork about the income tax deductions and types of nonprofits that can be formed in the US and how they might interact a bit with foreign organizations. Lindsey is going to take us into the world of treaties so that we can see where gifts to organizations outside the US can easily be made because there's a treaty. And Jason's going to wrap it up, I think, by telling us about if you're a US organization and you want to make gifts outside the US and the treaty doesn't help, what are the things that you need to do before you can make that grant? So we'll get started. Let's see, Jason, you have control, right? Can we go to the next screen? Thanks. So our first idea is the general rules about donors and income tax deductions, because we all know that that's not 100% why people give, but I would never want it to be 100% of why people give, but we still want to talk about it. So from a US citizen point of view, your US tax deduction comes out of 170C, IRC 170C, and it allows for deductions for transfers to organizations described in 170C2. So those two sections will come up as we go through the presentation, but I will tell you that 170C2 focuses on the deduction to US organizations. So when we want to look at deductions for other organizations, we have to do things a little differently. There's also a deduction from the estate and the gift tax. So IRC 2055 says if an estate makes a contribution, it's deductible. And 2522 says that when there is a gift, 2522 says when there is a gift, there's no gift tax on it. So here's an example. We have Dorothy making a cash contribution of 100 grand during the calendar year. Her AGI is $1 million. Her contribution was $100,000. So in just a couple of minutes, probably the next slide, we're going to talk about percentage of AGI limitations. But for this simple example, Dorothy can deduct 100% of whatever she gave against her AGI because she contributed cash. Now there's a special thing going on right now that planners need to know about. At least through the end of this year right now, you can give an unlimited gift of cash, no matter what it is, and deduct it against your AGI, and it's fully deductible, no matter what our other limitations may be, which we will talk about in a second. But for now, there's this tremendous opportunity to make cash gifts to organizations. So if we go back for just a second and look at Dorothy, her $100,000 gift was only 10% of her AGI. So she's in no danger. But when we talk about the AGI limitations, I'll bring this back to your mind. So what about non-citizens? The general rule is that if you are a US resident or a US tax domiciliary, then you get the same rules as a US citizen. It's not that tricky. The same way it works for our income tax, it works for these deductions. If you're a non-resident, though, you can only take a deduction for charitable deductions that are from US source income. There's a lot of discussion about whether that source income needs to be connected to a US trade or business, which effectively means you're working here and you're providing services here. But the reality is you've got to file a US tax return, an income tax return, to take that charitable deduction. So chances are you've satisfied one or both of those because you've got US source income that you're needing to pay tax on. Okay, Jason, I think that's enough for that slide. So let's talk now about types of charitable organizations. When you apply to be tax exempt, the IRS default rule is that you are going to be a private foundation. And the only way you get out of being a private foundation is if you can qualify and show on your application that you fit some exception, or there's some reason that you should get a better classification than private foundation. And I say that in quotes because private foundations are actually the most restrictive type of designation because there are extra taxes you have to think about, certain things that you might want to do as an organization you have to be careful about because of these taxes. We're not going to go into the taxes, but I will tell you this, that some of those taxes, if the IRS applies them, apply not only to the foundation, but to the directors and the other managers of the organization. So the IRS is sort of the policing agency for private foundations. You apply, you get your status. For 5 years, the IRS watches your return pretty carefully. It's a self-reporting system, so if you do any of the kind of the bad things, then you have to tell the IRS you did it and tell them how you fixed it and say it'll never happen again. But they are watching for 5 years. The state attorney general, wherever you're formed, if you're formed as a corporation, which is preference, I think, for most of us, can also rule in and be sort of a policing agency for a private foundation. Let's compare that to public supported charities. So public supported charities, a private foundation is usually funded by a family or maybe 2 or 3 members of a family, but there's no general public support generally. It's just a single source or a very closely related source of income. For public charities, though, we don't have that limited sort of support. So public charities are organizations that provide services or provide some sort of charitable purpose to the general public, or at least a broad enough class of the general public that the IRS thinks we should give you tax exempt status. And we'll talk about these 3 different things, 3 different ways to get that generally gets designated as a publicly supported charity. But I want to compare all of these before we do. The private foundation has self-reporting and sort of the IRS and the Attorney General are paying close attention. In publicly supported charities, part of the idea is if you're not doing it right, you're not running the organization in a way that's going to support and attract public charities public support, then you're probably not going to be able to maintain that publicly supported status. So sort of the policing falls a little bit more into donors too. You have to make sure that you're doing what you told donors you were going to do and that they like what you're doing. It's not to say the IRS and the Attorney General can't also pop into that kind of conversation, but the donors are really important. So let's talk about the ways to get classified as a public charity. One of them is just a definitional thing. If you are providing a charitable purpose to broad general public, like churches, hospitals, universities, even governments and governmental units, you could get public charity status because you are doing things that sort of ease the burden on everybody else, right? So you're providing enough public benefit. The most common, though, are the second class on here, are publicly supported charities. Those are the ones generally that get a third of their support from the general public. So our first classification is donative. That's general public donations count for a third of your support. Revenue-based means if you are running some sort of program like a museum and you charge admission fees, or you've got some merchandise sales that help support what you're doing and they're related to the purpose, then you can get a third of your general support test satisfied through those revenues. The one thing we can't do is count in net investment income. So if you've got a big endowment and you think we're just going to sit back and collect, a great amount on our endowment every year, it's not going to work. That's not a reason for the IRS to give you public support, public charity status. So the last one we're going to talk about is supporting organizations. And Jason, why don't we just go ahead and switch to the next screen? So you see that 509A was just mentioned in that last thing. So one thing that I wanted to talk to you about that I kind of forgot to talk to you about is, how do you find out? You as an organization will know exactly what your classified is, but how does a donor look for that? And there's a couple of ways. You can get a determination letter, a copy of the IRS determination letter from the organization. That's not always easy to do and not expedient. Or you can go on the IRS website. They have a charities search function that will give you a little code. For example, private foundations will say PF next to them, so you can determine if it's tax exempt and what kind of organization it is. And then there are some third-party websites that you can go to gather that information. What the determination letter will tell you is that the IRS has determined that the organization is exempt under 501c3 and is not classified as a private foundation under 509A. So that's kind of the language that you want to see. It's a sort of a somersault. We are not classified as a 509A means perfect. It's a public charity. So sorry on that sort of tangent there, but I wanted to bring that up. So back to supported organizations. Jason's going to spend some time, I think, with this, but I'm going to hit some of the highlights on it. A supported organization is a U.S. nonprofit that's designed to support one or a few specifically identified public charities. And so you sort of piggyback on, in a way, to their public charity status by saying, we're going to support them. So here's our example. Dorothy is now a billionaire because her business went really well. She wants to support a range of charitable organizations, including several foreign countries. Rather than create a private foundation with her contribution of $100 million, Dorothy decides to create a supporting organization that will support a very large public charity that routinely makes grants to scores of domestic and international charitable organizations. So what Dorothy's decided to do is to create this other organization that will in turn make gifts to, like I said, scores of domestic and international charitable organizations. So she is supporting these other public charities. And that's a classification that will get your organization public charity status. We are going to talk in just a minute about some different types of public charities. Some different types of supporting organization classifications, but that's the general idea. Coming up in the program, Jason's going to talk about some of the special rules for U.S. organizations that want to have foreign activity, make grants outside of the U.S., and some foreign charities in general. So just know that that's coming. But now let's, Jason, if we can, move on to the next slide. All right. I'm going to pick up the speed a little bit so we get everything covered. So here's our U.S. income tax discussion about donations by, first category, U.S. individual donors. So income tax deductions are limited to gifts to U.S. charities, and that's where we get 50170C2A. Now, when a donor makes a gift, they are limited to a percentage of their AGI that they can actually deduct. Remember, in our very first slide, we talked about this thing right now in 2021, where no matter what size cash gift you give, you can deduct it even up to 100% of your AGI. Let me tell you what the normal rules are now, so you can compare that and see why that's such an impressive thing and such an option we should all be considering for our clients. Typically, if you make a donation to a public charity, to one of those publicly supported type organizations, you can deduct up to 50% of your AGI. If you are giving to a private foundation, so it's one of the family members or the close group of people forming and funding this private foundation, you can deduct up to 30% of your AGI. Now there's a deduction reduction rule that says if you are giving kind of hard to value assets that you might have some control over the value, then the rules kick in and focus in on that, because the IRS doesn't like people controlling the value. So if you're giving anything other than cash or marketable securities, mostly, your deductions are going to be what I just said. But if you are giving appreciated property, capital gains type property, then there's a 20% limit on gifts to private foundations, and your 50% limit to a public charity drops down to 30. So we have to make sure that we're paying attention to those AGI limits. But otherwise, an individual gets deductions for gifts to U.S. charities, but they can't earmark any of their funds to go to a foreign donee. The IRS says, well, that's basically the same as giving it to a foreign donee, so it's not going to work through this rule. So we'll talk about that when Jason gets the screen. U.S. businesses can also get charitable deductions, but they're limited to 10% of the taxable income for the year. And the use of those gifts by corporate foundations has to be within the U.S. So we can't give a corporation giving assets to a foreign organization either. We've got this limitation on the corporate deduction. And then finally, U.S. estates and trust. Generally speaking, when an estate or a trust is going to make a gift to a charity, there will be a deduction to the estate or for the trust. So as long as you're making typical gifts to U.S. charities, it's not going to be a problem. A couple of limits: you have to do it within the year, or you have to permanently set aside for charitable purposes. And set aside sounds so easy, but it's really kind of not. You have to be careful about the way you say you've set aside assets for that. So just a warning note, if you ever come across that, know that there are some specific rules that are beyond the scope of this, but that you should look up, and we'd be happy to help with those. So otherwise, one strange thing about U.S. estates and trust is that they can give gifts to foreign charities, even foreign governments, as long as those gifts are for charitable purposes. Okay, Jason, let's hit the next slide. This will be my last couple of slides here. Our foreign organizations. We want to talk about a few types of those. For a while, I used to hear a lot about friends of organizations, and you'd see, that in the name of an organization, and that would be a U.S. organization that is receives taxable contributions from people in the U.S., and then they send them to foreign organizations. Here's an example: the United Nations, is not a U.S. organization, but there is a Friends of organization called the Coalition for International Justice. So you can give to that organization in the US and get a tax deduction, and then it will funnel the money back to the UN, so that the Friends of organizations helps with that. There's also Friends of Private Foundations. These are, I haven't come across too many of these, to be honest, but the two types that you come up with are a conduit private foundation and a private operating foundation. So these are organizations that are just supported by a few people. Other donors can make contributions to them and get a tax deduction. Conduit private foundations are ones that just funnel the money through. So they're set up to do that. A private operating foundation is a specific type of private foundation that gets treated as a public charity because it's running its own programs. It's providing public support. It's providing services to a broad enough class of people through its own its own projects. So you can have a Friends of organization that's actually a private foundation if it's one of those types. Okay, Jason, last one. So here are some examples of some other examples: the American Friends of the Louvre, Friends of the China Heritage Fund, Doctors Without Borders. All of these things have organizations in the US to take deductions and funnel them back and allow the US taxpayers to get the deductions. So this is where I want to spend just a couple of minutes about types of supporting organizations. When you get classified as a supporting organization, and remember, that's the one where your job is to support a specific number of charities or a specific group of charities, there's three types of classifications. Type 1 is, you sort of thought of as a parent-to-child relationship between the supported organization and the supporting organization. These have to be, you can see there, operated, supervised, or controlled by the foreign charity. So you're going to have people sitting on your board, people involved with your programs who are from the foreign charity. So there's enough of a relationship there to recognize the connection between the two. Type 2 is a little vaguer. It's the brother and sister type of arrangement. That one means you need to be supervised or controlled. So remember, the first one we had operated, supervised, or controlled by a foreign charity. The brother-sister is you've got to be supervised or controlled in connection with a foreign charity, so that in connection starts to bring some vagueness to it. So you have to be very careful about how you set up your connections between the two organizations. Being on the board is pretty easy, but being in connection with somebody takes a little bit more thought. These two are pretty common. Type 3, the IRS is not liking too much these days. So this is sort of the cousin one. This is where you've got to be only operated in connection with a foreign organization. And that is getting harder and harder to prove unless you are functionally integrated. And that means that there are tests that we have to run and determine that you meet the tests so that you are so integral to the running of the foreign organization that that connection should be recognized. Right, I talked for 4 minutes too long. Sorry about that, Lindsay. So I'll stop now and turn it over to Lindsay.
Thanks, Mark. All right, so this will cover a brief overview of the available transfer tax deductions for transfers to foreign charities. As Mark explained, for income tax deductions, typically the donee organization must be created or organized in the United States. And there are different rules for estate and gift tax deductions. The statutes cited, which Mark also mentioned, 2055 and 2522, are what govern charitable deductions for estate and gift tax purposes generally. And the subdivisions cited are those that address the contributions to foreign organizations. So under these provisions, a US donor or estate can qualify for a gift or estate tax deduction when gifting or devising property to a foreign charity. To qualify, the funds must be used for charitable purposes, as Mark mentioned, and the foreign organization must avoid the same prohibitions and limitations under 170C that relate to private endowment, political campaign activities, and lobbying activities. So as a result, deductions are not available for transfers to a foreign government or political body. And then finally on this slide, through a convoluted series of statutory cross-references starting from 2055 and 2522, you will find that it is very difficult to qualify a transfer to a foreign private foundation for a US gift or estate tax deduction. Jason, you can go to the next slide. Okay, in addition to the general rules that have been outlined on income and transfer tax deductions on transfers to foreign charities, the US has also entered into certain treaties with countries that address charitable contributions for the same purposes. The first category of treaties relates to income tax deductions. These treaties are between the United States and each of Canada, Mexico, and Israel. And each treaty provides a reciprocal deductibility of charitable contributions for income tax purposes. The income tax treaty with Canada allows US citizens and residents to deduct donations to Canadian charities. The deductions can only offset Canadian source income. And as Mark discussed the limitations on the deductions with respect to adjusted gross income, those same limitations apply to the charitable deductions, but those are applied only with respect to the Canadian source income. The US treaty with Israel also allows these deductions for contributions to Israeli public charities or private foundations, but the Israeli entity must otherwise have qualified under US law as a public charity, and the contribution must be of a sort that would be deductible under US law. As with Canada and with Mexico, the deductions can only offset Israel's source income. And here there are unique percentage limitations imposed on the deductions, again, applied with respect to the Israel source income. Finally, the US treaty with Mexico is similar, allowing deductions for US donations to organizations in Mexico that are public charities. Again, the deductions can only be taken against Mexico source income, and the same percentage limitations under 170C are applied with respect to that income. For all three treaties, in order to get the benefit of the treaty, more than 50% of the organization's beneficiaries, members, or participants must be themselves entitled to receive the benefits under the treaty. One example is if you're an individual resident of the US or the other country, you are entitled to the benefits under the treaty, so that would help qualify. Okay, Jason. Oh no, not next slide yet, no, sorry. Okay, there's two other categories of treaties. The second category relates to transfer tax benefits. These treaties are between the US and each of Canada, Denmark, France, Germany, and Sweden. And the gist of the transfer tax provisions is similar among the treaties. Each provides a tax exemption or deduction on a transfer to a charity in another country, but the qualification for the benefits and the benefits themselves are slightly different. And I'll just briefly overview the US-Canada transfer tax provisions. And those are actually contained in the Canada-US Income Tax Treaty and a 1994 protocol to that. Under the protocol, the taxation of property transferred to a charity on death is governed by the law of the decedent's country, and the recipient, the charity, is treated as a domestic entity for purposes of the treaty benefits. So if a US decedent leaves property to a Canadian charitable organization, the decedent's estate would be entitled to the full US charitable deduction on that request. Okay, the third category is the reciprocal recognition of income tax exempt status of charities, which means that a charitable organization recognized as tax exempt in one country will be recognized as tax exempt in the other country. There's actually 4 treaties that provide this recognition, and they are the treaties between the US and each of Germany, Netherlands, Mexico, and Canada. And in some cases, the organization must meet the tax exempt requirements of the other country in order to qualify for the benefits under the treaty. Also, just a note that the United States will automatically classify the foreign charity as a private foundation for US purposes unless the foreign charity submits an application to establish that it is a public charity or a private operating foundation. This isn't a requirement, but it is a good idea if it would qualify for better classification. And as Mark mentioned, you can go online now. I think it's still called Publication 78, which is available online, where you can determine whether the foreign entity has sought public charity treatment in the US. Okay, Jason, now the next slide. Okay, so Dorothy. Dorothy has made her billions of dollars. She's retired and now splits her time between the United States and Europe. She becomes very involved in an orphanage and would like to construct large new facilities in multiple European countries. She also wants to conduct fundraising activities in the United States and decides to create a charitable organization in the Netherlands. So what does that mean for Dorothy? Because of the US-Netherlands Treaty, the tax-exempt status of Dorothy's charity in the Netherlands will cause the charity to be recognized as tax-exempt in the United States, as long as her charity meets the tax-exempt requirements in the United States. However, the treaty does not allow US donors to make direct contributions to Dorothy's charity and claim a US income tax deduction. The treaty just does not provide that benefit. Okay, next slide. Okay, this slide addresses a few rules that apply to transfers to and distributions from trusts where foreign entities might be involved. The first bullet point relates to section 679 of the code. And this section causes a US transferor who transfers property to a foreign trust to be treated as the owner for income tax purposes of the portion of the trust attributable to the property transferred, if there's a US beneficiary of any portion of the trust. There's a list of exceptions to that rule in the Treasury regulations, including -4A3, which excludes any transfer of property to a foreign trust described in section 501c3. So the gist is that the transferor will not be treated as the owner for income tax purposes of a wholly charitable foreign trust. Okay, the next 2 points relate to split interest trusts, which you're all familiar with. With a charitable remainder trust, the grantor makes a gift to an irrevocable trust and provides an annuity or a unitrust interest to be paid to himself or another set of individuals for a specified term of years or possibly for the life of the individual. And the remainder interest is payable to charity. And there are, of course, tax benefits to the CRTs, including a gift tax charitable deduction for the present value of the charity's remainder interest and getting the assets going into the trust out of the donor's estate for estate tax purposes. But unfortunately, foreign charities will not work with the charitable remainder trust because foreign charities are not permissible remainder beneficiaries. This is governed by Section 664 of the Code, which requires that remainder interests in a CRT be distributed to an organization described in 170C, which, as Mark told you, only includes organizations created or organized in the United States or DC or a US possession. So if your client's charitable inclinations are solely with respect to charitable or foreign entities, you need to move on from the charitable remainder trust. The other type of split interest trust might work, charitable lead trusts. This is also a split interest trust, but in this case, it's the reverse. The lead interest is the charitable interest, and the remainder interest is payable to the non-charitable beneficiaries. Again, there are tax benefits to these types of trusts. First, on creation, the grantor gets a gift tax charitable deduction for the value of the charitable lead interest. And as well, the assets are removed from the grantor's gross estate for estate tax purposes. The income tax benefits of these trusts depend on whether the trust is a grantor CLT or a non-grantor CLT. In a non-grantor CLT, any income is taxed to the trust, but as Mark mentioned, under 642C, the trust is entitled to a charitable deduction for the annuity or unitrust interest being paid to the charity. And this can include distributions to foreign charities. In the grantor trust, charitable lead trust, as with any grantor trust, the grantor is treated as the owner of the trust for income tax purposes. At the outset, the grantor gets an immediate income tax charitable deduction based on the present value of the charity's interest. But during the trust term, the grantor, instead of the trust, is taxed on the trust income. So under this arrangement, there is no 642C deduction for the trust because the income isn't being taxed to the trust. So with that, I will turn it over to Jason, who will be discussing foreign activities of US charitable organizations and certain withholding issues for both US and foreign charitable organizations. Thanks so much.
Thanks, Mark and Lindsey. Just before we shift to the outbound perspective, wanted to clarify briefly for inbound type transfers, or more specifically where foreign organizations are looking to fundraise in the United States, which of course is a very large economic market, and there are definitely multiple organizations who who want to focus on the United States. As Mark mentioned, the income tax deduction for U.S. persons, unless there's a treaty provision like the ones that Lindsey described, the U.S. donor must contribute to a U.S. Qualified charity in order to receive the income tax deduction. So for foreign organizations who do want to create a U.S. organization, like Mark was describing, a friends of type of organization. The same analysis that he mentioned applies. It either would be classified as a private foundation or a public charity. Of course, the public charity is the more advantageous one, like Mark also described, better tax benefits for the donor. The trick, though, for these friends of type of or quote affiliated organizations, where it's a foreign organization wanting to do fundraising in the United States, is there has to be enough separation between the U.S. charitable organization that's being set up and the foreign charitable organization, or else the U.S. will come in and say, no, this is just the conduit type of scenario that we said you couldn't do, and that Congress said that you couldn't do. Congress obviously wants the majority of funds going to charities, U.S. charities, to be benefiting the United States, because of course there's a tax benefit tied to those. But it is definitely feasible to create these friends of organizations. You just have to provide enough separation, and that's why the difficulty sometimes arises, especially in the supporting organization world, where there has to be this connection. So that's one of the reasons why that part is very tricky. Okay, so but we're happy to discuss that with anyone who would like to explore it. Now switching to foreign activities of U.S. charitable organizations. So in the private foundation realm, again, which is a default classification for U.S. charitable organizations, and when the U.S. is looking at foreign organizations, the default classification for them, direct activities are permitted. So let's say that a private foundation, a larger private foundation, even at one time the Gates Foundation, wants to do a lot of international programs, even as the example here, constructing facilities in foreign countries where they want to distribute medicine or help to those countries, residents of those countries. That is permissible under U.S. law. U.S. charities can do operations in foreign countries and carry out their activities there. The tricky part in this context, where we're looking at the outbound again, grants going from U.S. private foundations to foreign charities, those the check writing type of help, not where you're actually constructing facilities or paying people to go somewhere and do your charitable activities and carry out your purposes, but where you're only writing checks, you're making grants. Those are permitted, but the private foundation has to either exercise expenditure responsibility, which is this more complicated tracking and reporting regime that's under U.S. tax law, that essentially is in place so that private foundations, which as Mark mentioned, are monitored more closely, so that private foundations will in fact do charitable things and pay funds to have charitable activities and benefits carried out. So a grant to a foreign organization from a private foundation, expenditure responsibility required unless the foreign charity has an IRS determination letter, which is entirely possible. As Lindsey and Mark mentioned, foreign charities, even if they're not under a treaty with the U.S., can apply to the United States and be recognized as a charitable organization, not to qualify for deductions under U.S. tax law, but to do things like this, to receive grants from U.S. private foundations without having to subject the private foundation to expenditure responsibility, the extra reporting, and so on. There's another option, which is called an equivalency determination. That is a private version of the IRS process to determine that a foreign organization is a charitable organization. So typically that's done by legal counsel, and it's an involved process that results in a pretty lengthy finding or opinion that would show that this foreign charitable organization that's receiving this grant from this U.S. private foundation is really a qualified charity under U.S. law. Or there's a much rarer exception here, where the foreign charity is recognized under federal law as as exempt. The equivalency determination rules changed in 2017. Prior to that time, it was actually a little easier to do this process. Under Revenue Procedure 92-94. There was still extensive due diligence, but these grantee affidavits, which used to be available under the Revenue Procedure 92-94, unfortunately no longer satisfy the equivalency determination rules. So there are some organizations. There's a consortium that collects these equivalency determinations and makes, I think it's NGO source, I believe, and that also is searchable online, where it's a clearinghouse of these equivalency determinations, so that it makes it easier for for grants from other private foundations in the U.S. to benefit those foreign organizations and not have to go through this whole process, either the expenditure responsibility or their own equivalency determination. So that's a very useful tool when it's available. We only have a few minutes, so I'll cruise through some of these. Excuse me. It's also possible for U.S. private foundations to do program-related investments. So this is an exception to one of the private foundation rules on jeopardy investments, that you can't jeopardize the funds and investments of the private foundation. So you are allowed to effectively do that where you're making either an investment or a loan, typically a below market interest loan that's non-standard, if it's to carry out the charitable purposes of the foundation. And one of the factors, the rules, as you can see, is that the return on investment can't be a significant factor. So it looks more like a grant than an investment or a loan. And sometimes it does end up as that. There's no return really. But there's also prohibition on all of the political things that Lindsey mentioned, that U.S. charities are prohibited from doing. Or at least limited in that regard. So it is actually possible for a program-related investment to be made to a foreign charity. There's a couple of examples there. There's a whole series of examples in the regulation that deals with program-related investments. So we'd encourage you to look at that or give us a call if you're interested in that. It is a unique area. It's been around for a long time, since the 1969 Tax Act, but it's become more prevalent. Program-related investments have become more prevalent in the past 10 to 20 years. For U.S. charities, now switching again our hats and our classification, where we're talking about grants from U.S. charities to foreign charities. All of these rules that we just described that relate to U.S. private foundations don't apply to U.S. charities. By and large, U.S. public charities do follow these same types of rules because they do represent best practices in the charitable area. But public charities, U.S. public charities, aren't required to follow all of these rules, like we just mentioned. Expenditure responsibility, or else getting an equivalency determination, or one of the other alternatives to show that the foreign organization is in fact a qualified charity. So U.S. charities are not restricted like that, and sometimes that is what drives our recommendations and the charities decision on whether to pursue becoming a private foundation or a public charity for income tax purposes. And so a lot of effort goes into making sure that a new organization can in fact qualify as a public charity in order to at least have a lot of these extra rules minimized. Still generally follow them, but not to the letter like the private foundations have to do. So last thing, and then we'll try to answer some questions here. Excuse me, on the foreign activities, certainly in view, both at the IRS and at the Treasury level, is terrorism and money laundering and all of the other things that that U.S. law has tried to combat increasingly over the past 10 to 20 years, especially after 9/11. So these issues should be addressed in a new organization's or an existing organization's documents. The IRS certainly pays attention to these things, and if there is a strong international component, which is fantastic and in fact encouraged by the IRS, that's not that they have anything against helping the international folks and organizations who are out there. But you do need to address and make sure that these issues are addressed about anti-terrorism and the Office of Foreign Asset Control, making sure that those provisions are in the legal documents and the exemption application that's submitted, because otherwise you definitely will receive follow-up questions from the IRS before they will declare a new organization to be a charitable organization. So those are important issues to know about. One more thing, and this gets complicated too. So for withholding purposes, there are rules on withholding taxes that can apply if a U.S. private foundation or public charity makes payments to a non-resident. As you can see there, and we highlighted, we actually have a private operating foundation, which is sort of the hybrid, treated sort of like a private foundation, but also qualifies for public charity purposes for the deduction and grant making. Just a quick example there for you to refer to, but these issues can pop up and also pop up in the context of foreign private foundations, which again we described as the default classification for foreign charitable organizations. They are subject to an increased withholding rate on their gross U.S. source income, investment income. So that has to be reported. And foreign public charities are not subject to these withholding taxes if they have a determination letter, or in this case, you can actually get a more relaxed opinion of U.S. counsel. It still would have to jump through most of the hoops, but not quite as involved as the new revenue procedure on equivalency determinations. So with that, we will see, are there any questions in our last few minutes? Mark, did you see any that we can answer here? I know one of the earlier questions was, is it more beneficial from a deduction standpoint, from a donor standpoint, to give to a private foundation or a public charity? I think we've emphasized that a few times here, but definitely the public charity confers more income tax benefits for gifts to public charities. So again, whether you're creating a U.S. organization for U.S. clients, or if it's a foreign organization wanting to create the Friends of type of charitable organization here in the U.S. to seek U.S. donors' contributions, the public charity is always the focus where it's possible.
My only thing I'd say maybe in addition to that is that if you're doing a private foundation, it may be that the control you can have over it somehow is more important than the tax benefits for other donors.
Right. That's a good point. And that does drive this sometimes. One of the prices that you pay for having that increased control is that you typically are classified as a private foundation. So that's good point, Mark. You generally have to have more independence in order to qualify as a public charity.
So there's one other question. A U.S. citizen who is a resident of Australia gives appreciated securities to an Aussie public charity and does not take a U.S. charitable deduction. Is the U.S. taxpayer subject to U.S. capital gain tax on the gift? I've read that one a couple of times, trying to make sure I understand it.
Yeah. So I don't think that's one where we would definitely need to analyze. I don't think that the U.S. treaty with Australia deals with charitable any charitable issues. Excuse me. So it's I don't know that it would be a gain recognition event. I think it could potentially though be a taxable gift from the U.S. person. Because they're a U.S. citizen, it's mentioned here, but that's one that we would need to analyze more closely and probably do a little research before we came to any conclusions. Some of these scenarios do become very complex very quickly, especially where you're dealing with international philanthropy. But as we've outlined, hopefully for you here, it is possible to navigate, and with sometimes a little extra time and diligence, it is entirely feasible for U.S. folks and charities to benefit foreign organizations or operate in a foreign country. To do good there, really as much as it is here in the United States. It's just that on the income tax side, you have to jump through the U.S. hoops in order to have a deduction on this side of the pond, unless there's a treaty involved, as Lindsey highlighted for us. I think that concludes. If anyone else has additional questions, again, please feel free to reach out to us. Our team, I failed to mention, our team has a relatively new audit program that we developed for nonprofit, charitable organizations that we'd be pleased to discuss. It goes through the entire sphere of charitable organizations, operations, and legal issues. So we'd be happy to discuss that as well with anyone. But we thank you again for attending here. One person mentioned, I believe, that this presentation will be posted to our website, to the International Private Client website under media, I believe, Jen, that's correct, the multimedia. So but we'd encourage you to look at some of the other presentations there, and there will be several others in this series forthcoming. Thank you all.